Businesses that are created by people, managed by people, serving people, and owned by people are obviously a lot like people. Each is distinctive, and like people, some businesses are far better than others. Let's first take a look outside the CPA world to make a point about operational excellence and why that difference makes such a huge difference in an industry that many view as a commodity service, freight hauling. You're probably thinking to yourself, how much different could one trucking company be from another? You buy or lease trucks, hire drivers, advertise your services, and charge essentially what the market will bear for, again, what is a fairly simple business. Yet within that industry, there is a company named Heartland Trucking Express that is far different than its peers, earning a healthy 10% a year ROA and 20% ROE while carrying essentially no debt. Why do they do that? Exceptional operations management. Heartland is one of the most efficient trucking companies in the U.S. Its operating expenses as a percentage of revenue are the lowest in the industry. Consequently, it has the highest profit margins. That difference in profitability makes a huge difference. Many of Heartland's competitors don't generate enough cash to afford their investment in trucks, so they need to borrow millions and millions of dollars each year and pay millions of dollars of interest. Heartland, in contrast, gushes cash, about $100 million a year in excess cash flow, so they can easily satisfy their CapEx needs and return generous amounts to shareholders. Now, let's switch gears back to the CPA world. Would you agree that at least some outsiders view parts of the accounting service business as being commodity-like as well? Perhaps at least in the area of audit-related services and maybe tax compliance services. Of course. Now, back in the olden days, during my years as a Big Four partner, net income as a percentage of gross revenue, or what I call net to gross, at my firm was about 20%. Today, a huge number of non-Big Four top 100 firms in the country have net to gross ratios in the 30 to 35% range. A handful of firms out there do way better, 45% or even stronger. Now, you being accountants, you can do the arithmetic to see just what a difference that difference might make to your take-home paycheck. Now, I know what you're probably thinking. Oh, those high net to gross firms are probably sweatshops. Their partners are likely working non-stop, and they must run their staff totally into the ground. Well, if you really look under the hood at those firms, you'll find that their partners work about the same number of hours each year that you do. And they bill roughly about the same number of hours each year that you do. Ditto with their accountants. You'll also see that their billing rates look a lot like yours do as well. So how do these firms get such great results? What it boils down to is the management's pig-headed attention to operational excellence, the exact same stuff that Heartland Trucking relies on. Things like a relentless focus on risk management. Things like an appropriate hiring and staffing of engagements for the complexity of the work that's performed. And then finally, keeping non-employee operating expenses under scrutiny. In short, it isn't sexy stuff, but it's practiced in a disciplined manner by those firms every single day. Look, we know that making an extra $100,000 per partner per year or an extra $300,000 per partner per year isn't important to everyone. However, if it's important to you, maybe we should talk. Please contact us at CPA Growth Partners to have an initial cost-free conversation.